After a long day of hiking, it's time for a bit of a swim in my snazzy bathrobe kind of outfit.
Struggling to go up. The girls, we still won't have anything to do with this.
So this weekend we went to the mountains and it was a lot of fun, but also it gave me a chance to have a little bit of time to really think about a couple things. One thing that really came to mind is that I just kind of been thinking about how many emails I've been receiving from members, clubhouse members, my direct clients, and they keep asking me, when will this bull market end? And while I think that's a valid question, the reality is that we remain in a bull market, certainly in US equities, but also in European equities. So I'm gonna show you guys a couple things right now to put this whole thing in context, because one of the biggest things that I've learned over the past 20 years is that it's much easier to trade with the trend. And that might sound an obvious thing to do. It becomes very easy to slip into these sort of contrarian views. And having a contrarian view is one thing, but fighting a major trend for, like some people have been doing for 70 years in US equities, just isn't a really good way of making money. So let me show you guys a couple things to kind of contextualize this bull market and to make sure we remain riding with the trend.
Okay, so in order to give you a little bit of perspective that it's not worth fighting a bull market, let's kind of have a look at where we are. This is the S&P 500 as represented by the SPY ETF, and you can see here we have very clearly defined the basically it was an almost 14 year bear market from the year 2000 all the way back to the year 2013, where we broke into a new so-called secular bull market. The secular bull market and the cyclical bull market, which arose out of the 2009 ashes, is now arguably getting somewhat long in the tooth. At least the cyclical bull market is. So yes, a lot of people are calling for this to be, overextended and all sorts of things like that in the near term. And I'm not necessarily disagreeing with that, but it is very annoying that if you have that opinion, if you then don't buy once you have a dip, and the dips tend to be shallow, and secular bull markets, again, that's these 15, 20-year phenomena, they tend to surprise on the upside. That's just one of the things that they do. Now, again, it's not impossible to have a 10, 15, 20% plus correction in something like the S&P within a cyclical bull market. And I do think we are probably not too far away from that, but I don't think that's the immediate term call. So let's have a look at another chart of the S&P. If you look at the S&P in this way, you can see that here too, we continue basically holding a 200-day and the 50-day moving average is basically right off the 2016 January low. So here too, nothing's really changed. I think the S&P 500, particularly if you look at the S&P 500 cash index itself, the SPX index, at this point, it's got to drop below 2,400 for us to get at all nervous. At this point, it remains a well-defined uptrend, and unless we break 2,400 on a weekly closing basis, and that's certainly possible, I think for right now, freaking out doesn't make a lot of sense. July tends to be a decent month for stocks. They actually tend to rise a little bit more than 1% on average in the month of July, US stocks that is. So here too, it's not really worth fighting that. In terms of a couple other things, what people have been writing to me a lot about recently is basically this relative weakness of large cap tech stocks, which have carried a big part of the US equities for some time. And you can see Apple bumped into the upper end of its real big picture uptrend, and this took place in May. So it's not so surprising. In fact, it's not coincidental in my eye that we started giving back some from there. And in fact, the large cap tech stocks continue to underperform the broader US stock market ever since essentially really early June. June 9th was the day when things started to go a little bit awry. But what has happened in the meantime, and that's what's so important and what I teach my clubhouse members, my direct clients, my mentorship clients, anyone that I talk to on a daily basis, I teach them about sector and group rotation, and that's exactly what's been keeping this market alive. Yes, the Apples and the NASDAQ 100 and those kind of things have been underperforming, but there's been other parts of the market that's come to rescue. And if you look at, for example, the XLF, which is the financials ETF representing the financials in the S&P 500, you can see they've been having a nice breakout. In fact, there was a head and shoulders pattern, which would have been quite bearish, and that's now basically been negated to the upside. So a bearish pattern that actually ended up being bullish, and that can be quite bullish. from an intermediate, near to intermediate term perspective. So you can see here, too, in relative terms at the bottom, financials versus the S&P 500 also showing relative strength through the past couple of weeks, and of course up here, the absolute chart. So what's been happening is that even though large cap tech has been taking a bit of a step back and people have rotated out of that a little bit, we've seen that slack to a good extent having been picked up by financials, but not just financials. We've also seen small cap stocks, which actually are a good amount of financial companies are small cap stocks, which is why we have something like the Russell 2000 acting well. The Russell 2000, the IWM ETF here, you can see actually holding up even a little bit better, marginally speaking, than the S&P 500. That's not it. Look at the transportation stocks. I talked about the transportation stocks all last week to my clients, and you can see the transportation stocks. You can look at the IYT ETF here actually breaking marginally higher. So these are really important parts of the market that are starting to pick up that slack at the large cap tech stocks, which are very important to the market. But we've seen this rotation between financials, between transportation stocks, and even biotech. We've talked about the healthcare space for some time. That kind of pickup over the past few weeks, that has really managed to help the market, keep the market alive. And I do think as long as that sort of rotation continues, the cyclical bull market can remain intact. As soon as we start seeing a more broad-based pullback where financials pull back, tech pulls back for more than just a day or a week, once we start seeing a move into more defensive stocks on a broad-based basis, which we have not seen in a long time now, not until then would I say is it time to really start getting very defensive in terms of your positioning for and calling for maybe the end of a cyclical bull market. So I hope that made sense, guys.
Also, in the month of June, we did a very successful trade in biotechnology stocks, and we detected that breakout before it actually happened. And I received a lot of questions from people asking me if I could show that in more detail. So I decided to do a webinar. We're going to do a webinar on Wednesday, that's this week, Wednesday, July the 5th. At 4 o'clock Eastern, so 4 o'clock New York time, 1 o'clock Pacific time. Make sure to join us for that. I'm going to show you guys exactly how we did that trade, how I came about finding in the trade before things actually broke, how I used my proprietary indicators, including the beta reversal indicator and other things, and how you can do so as well. So make sure you sign up in the link down below. Again, that's Wednesday, July the 5th at 4 o'clock Eastern, 1 o'clock Pacific, and I'll show you guys exactly how I did that trade and how you can do it as well.